Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was looking through the comment section. Again, this channel is a lot about finding value wherever it is. I'm not in any one sector or any one thing. I do like commodities a lot, and I do think emerging markets and some of the non-dollar stocks might do very well. I also think if you don't want all of the volatility, you could get emerging market bonds or non-dollar denominated bonds, Canadian or wherever you're looking. That's another way that you could diversify and maybe reduce volatility. In this particular one, it says, "Hi Andy, what would the time frame on precious metals trade be, and what kind of returns are you expecting versus other commodities you cover, such as uranium? Outside of basic diversification, it's difficult to determine where we should be investing within the commodity space to maximize returns during this upcoming super cycle." Now, here's the difficult portion. You say maximize returns. When I read some things, I also think about risk-adjusted returns. Where can we get really good returns at the lowest possible risk? And then you've got your sectors that are just completely volatile. You're swinging for the fences. You just go big in those sectors. So what I do is I try to capture all of it. And if you look at my entire net worth, and I don't have probably the ideal portfolio, I try to get between 20 and 30% of my entire net worth into physical precious metals. And if you guys haven't seen my swapping, where I swap between different physical metals, that's what I do. And I'll put it in the description below what that looks like and how it works. Where you swap a physical asset to another physical asset based off ratios, just using physical precious metals like the real deal, going to a dealership, swapping it out at the right times. And this isn't like you do it often. You buy physical metals, you accumulate for maybe a couple years. You may wait 3 years, 4 years, 5 years, 10 years, somewhere in that range, and then you swap it for something else. And you can create a lot of wealth swapping between assets at undervalued and overvalued spots. So you can generate a lot of wealth in a low risk return way, and I do a lot of that. I also take some portion of my money. I'm going to say 20-30%, somewhere in there. And that is where I put, and I swing for home runs in the stock market. That's where I use the technical analysis, the timing. I do all that stuff that you've seen in a lot of these clips. And then I go and swing for the fences with the most volatile companies that have high debt. And I try to hit home runs. And then I diversify it out. I use about 1% to 5% of my total portfolio in each position. And I only have 20 to 30% of my entire net worth in those types of investments. I do have a 401k. It's in more, I'll call it mutual fund type stuff. And I spread that out in different mutual funds. And some of them, I've got emerging markets. I have some precious metals mutual funds, and I have some other ones. So that's something that I also do. So the ones that I think are very good to maximize returns in the physical metal portion, I like platinum and silver. Those are the two that I really like. Maximizing returns in using like royalty companies. I think precious metals royalty companies are good. I think like copper and nickel. I like Nova Royalty there. And it's a small royalty company. It does have some volatility. And it doesn't have any paying royalties at the moment. It is more of a developing, all their projects are developing projects with large mining companies. This is a very long-term play. And we're getting in kind of at the base, the ground level. Ely Gold's another one, Teuton Resources. Those are all small royalty companies. Ely Gold just got bought out by Gold Royalty. And Uranium Royalty, I'm starting to accumulate some of that. That's another royalty in the uranium sector, obviously. And if I were to take my biggest guess is if you're going to swing for the fences, oil and uranium are the two that I like for swinging for the fence. That's where I'm going the most aggressive with some chunks of my money. I don't know the exact percentages. I was probably not that much in oil in the beginning, and now it's massive because oil went up so much. I do have some very good returns on some of the companies that were in that sector. Many hundreds of percents, and some are even the thousands percents. So I did really, really well. Like TTI, I did very well in. SM Energy, CDEV, CPE's done pretty well. Crew Energy, Birchcliff, Reconnaissance Africa's done very well. And looking at it from this perspective, I still think uranium's pretty good. I think that's probably one of the higher returning areas. Copper's really good too. I think that's a lower risk, high return bet. Another way that you can play it is through diversified mining companies, because you diversify amongst the commodities and they pay you pretty good dividends. So I think their risk-adjusted returns are really good. BHP is a company I like. VALE, Vale, Rio or Rio Tinto, RIO. Glencore would be pretty good. Freeport McMoran, FCX. SCCO, Southern Copper. Alphamin for a tin company. That's not really a diversified mining company, but tin, if you want one tin, I threw that one in there. And then South 32, SOUHY. Norilsk Nickel, NILSY. Again, I might be missing one or two, but ANGPY, Anglo American Platinum is a good one too. I think all those are really good if you want to have a solid portfolio of diversified miners without taking a ton of the risk. It is still risky, and it's still going to track the commodity sector, but you're going to get really good returns and very good dividends in those companies. If you're young, it's not about necessarily swinging for the fence. If you're really young and you want to make a lot of money, it's about getting the returns when they're in front of you and ensuring that you're getting those returns. So if you know a commodity bull market's going to go up, I wouldn't pile into the exploration companies and be 100% exploration and think that you're going to be massively leveraged to the price move. What you want is you want to be sure to get in companies that will for surely move with the underlying asset, like whatever commodity it is. And then you want to make sure if it does have leverage that it is getting the leverage that you want to that commodity. If there's no leverage to the commodity, just buy the physical commodity. I wouldn't do a mining company at all then. So the way that I view things is if I can't beat the physical metals, I go straight to the physical metals and I just buy the physical metal. And that's where I store a lot of my money. It's a big bet. The other stuff is diversified, and I diversified amongst a lot of what I think are swinging for the fence type companies. And they're not all, a lot of them are not exploration. They're ones that have high debt that were just absolutely beat up at the bottom of the oil market. That's some of them. And then I look at uranium. I do have a lot of, we'll call it developers, ones that are developing mines. That's uranium. And then some of these other ones I play it with royalty companies because I think you get the leverage and you get to diversify the risk amongst a whole bunch of different royalties. So I like the royalty companies a lot. EMX is another one that I like for royalty companies. FNV, Franco-Nevada, Wheaton Precious Metals, just all of them. They're all good. Sandstorm Gold. You can literally search precious metals royalties and you could probably get an entire list of the royalty companies, and they're all pretty good for a good long-term hold. But that's my leverage play to gold and silver. Platinum, there isn't as much companies that I like. So I buy a lot more physical platinum than I do the mining companies. Mining companies, here's the problem. They usually outperform in the beginning of the commodity boom. And last boom, they went till 2004, and then the actual physical commodity outperformed the mining companies from 2004 and onward for the major, we'll call it the major sectors. Maybe not some of the small companies that were growing during that time frame. So you have to kind of, I think we're at the beginning of the beginnings. So I think that XAU is going to outperform gold. We're going to see that outperformance. It's going to do very well in the beginning of the commodity bull market. And then more towards the middle, beginning middle, it's going to peter out, and then the physical commodity will beat it, gold or silver or whatever. And they usually do very well on the back end. So we're still pretty early to this in a precious metals state. I think oil and uranium is going to take off. I think they're going to be more towards the beginning. Copper, I think, is going to be pretty steady and a pretty nice ride. Tin will do very well. I expect tin to do well. Platinum's going to be a fun one to ride up to. So I try to spread it out and capture the gains and diversify out. I don't diversify out to reduce risk. I diversify out because I want to capture the gains that those sectors have. The market balances out in front for copper, silver, platinum they're all very good. Oil, uranium looks excellent. And what I'm doing is I know that nothing's going to be perfect. They're all projections. If the market balance out there looks really good, I'm going to just say, you know what, I got to get something in it. And that's where I go, as I put something in them. And somebody said something about, isn't platinum used in catalytic converters? And won't that go down? That already happened with diesel. Palladium's the spot where it's in catalytic converters, but I think worldwide, catalytic demand is going to go up, not down. I know a lot of people think that electric vehicles are going to come out, but it's very American-based. The entire world's still growing, and the entire world still needs catalytic converters, especially in hybrid vehicles. And they're all upping the emissions requirements on them, which means they're going to load the catalytic converters with greater quantities of these precious metals, whether it's rhodium, palladium, or platinum. You also have in front of us fuel cells, hydrogen fuel cells, which uses platinum as their catalyst there to convert it back to water. So that's another spot that's going to be demand for platinum. Platinum's the cheapest of the PGMs, so I think that platinum is a very good bet. So looking at some of these, I'm just trying to get you guys caught up. If I were to do it, I would do it exactly how I'm doing it. If you want to diversify out of commodities, look into emerging markets, look into those other ones that are non-dollar based. And again, the biggest risk here, if this whole thesis were to go down, how would it go down? The thesis is based off of a weakening dollar, based off of inflation, basically. And the reason it's based off that is because of it's an expansionary phase in real estate, and that's where we're at the moment. The thing that would completely destroy this is if a whole bunch of homes came on the market all at once. Everyone flooded the market with homes. We would see a short-term crash, because that would be deflationary. The new builders couldn't compete with the new homes, and then prices would come down because inventory would get filled. That is where the risk is. So what I watch is the real estate market, and I'm looking at the inventory levels. The inventory levels, if they are below 6 months, I would say is favorable. If it goes above 6 months and starts getting above like 8 months, then I think that's where the problems could happen. But remember, this stuff doesn't happen quickly, but also we haven't shut down the economy, we haven't had forbearance, we haven't had moratoriums, we haven't had all this stuff. So there is a different factor underlying this market here, because we haven't seen this before. We haven't had something shut down, have it reopen like, hey, you can now sell all your homes all at once. That I don't know how they're gonna handle that, or if they're just not gonna handle it and just let people sell ad hoc all at once. If that were to happen, we could see a dip in the short term. So that's what I'll watch, and maybe I'll do a video on real estate and the update for July. If you guys like this content, give me a thumbs up. Appreciate you guys listening. This is Finding Value.